Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
All right, let's kick it off. We've got Claude back. Claude, how are you doing?
G'day, good to be here.
Very
Great
good.
to be back.
He's fought one of his ongoing battles with COVID. He is back and better than ever. We've got some good news to kick off with today. What were you going to say, Claude?
I was going to say COVID's a lot harder for me to defeat than like angry shit co-touts.
one of the enemies. Good. One of your weaker enemies. That's always good. Step one. We'll chat LaserBond and Dropsuite if we get through it all. Maybe we'll kick off with some good news. One that I think is pretty cool. India is the fourth country to put a lander on the moon. Yeah, space exploration has been done with an impressively lower budget than NASA and everyone else.
Yeah, it's super impressive. I mean, I'm big on space exploration. I love the idea of it, but I think the more notable point, or another notable point here, is just it's a very big tell of the rise of India. I mean, China gets all the glory, right? But India's a force to be reckoned with, right? They're actually going to surpass China population-wise. I'm going to forget the year, but not too distant future. They didn't have silly.
I think they've already passed them.
Oh, okay. There you go. Okay.
Yeah, I think it was 2023.
Okay, this year.
So.
Okay. God, it had me worried. I thought you were going to say like 1996 or something for a second there. Like really put egg on my face.
Yeah, mid-year this year is estimated, so I think it's happened. They reckon. I mean, these estimates are pretty hard. Once you get to like over 1 billion people, it's pretty hard to like keep count, right?
Yes.
But yeah, I believe it's already happened. Yeah, no, I agree. It's a very like promising sign of world's largest democracy making some pretty impressive tech progress. So.
Absolutely.
Cool.
Yeah, they are on the rise, and it is actually one of the more fertile places on Earth too. So India is just fascinating. I've been reading a lot up on it lately, and I really want to go there.
Have you been to India before? I was going to ask.
No, I really want to, but no, not at this stage.
Yeah, I was lucky to go. I've been like 3 or 4 times. 3 times for work. And 1 time for a friend's wedding. It's just a massive country. I could spend a lot of time there. Yeah. I think all the times I went, I didn't get sick though. And the last time I got sick, it does change your view getting a stomach bug. But other than that, they're just like, yeah, it's so huge as well. Like it's as you say, it's like 1.4 billion people. It's similar to China, right? It's just so hard to get your head around what it even is as a country. There's like so much diversity and just so much going on. So much. Each city you go to is like so different,
And it's an ancient culture too. Gosh, we're so 100%. Off topic here, but it is like it goes back. Like they were doing really impressive things thousands of years ago. So yeah, it's really cool place.
Yeah.
Please welcome to our new podcast, The Uninformed Histories of Ancient India, informed by reading 17 chapters of one book by William Dalrymple.
Book is like a tweet.
That's actually a pretty good book, though. I think it's William Dalrymple about the history of India. That's extensive.
I thought that was a totally made up name.
It might not be William. Yeah, it is William Down. It's called The Anarchy. The Anarchy is what I read.
Okay.
So it's about the conquest by the East India Company.
Ah, nice. Yeah, very
that's
cool.
Interesting. Yes.
Yeah. All right, moving on. Any other good news? Did you want to mention Qantas?
Alan Joyce is gone. There's some good news.
Yeah.
I think there's something very mob-like where, when the blood is running in the streets, you feel like you just want to pile on.
It happened quick. I didn't realize.
I'm not even reading the articles by the normal journalists at this stage. I'm just going straight to Joe Aston.
he was hating. He was hating on Alan before it was cool.
Yeah, exactly.
The public opinion shifted so fast. I didn't realize, because we mentioned this last week. I didn't realize there was it was everywhere. Like if you pick up the papers over last week, I guess it's so head down with earnings season. But yeah, now so he's out. Share price rose slightly, and now there's people are trying to take his bonuses away. Which I mean, I guess it's just the mob thing.
A, it won't happen. B, it will make zero difference. I mean, these are such sort of like cosmetic moves, as if like, who is it, Vanessa Hudson or whoever the new person is going to, they'll be doing the same things. I'll tell you one little rant I have here is that it seems lately a lot of the media is sort of making this point of they're putting profits ahead of shareholders, like, putting profits ahead of customers. Yeah, and like, well, what? Aren't they always doing? I mean, shouldn't they always be doing that? No, not in a bad way, but you would sort of say, if you're maybe a bit starry-eyed capitalist, you might sort of say that, well, actually, if you really provide good value to people, then you will grow profits and sort of win-win. That's sort of the idea here. But just the fact that it's only lately, since Alan's been in control, that they've decided to focus on profits. So anyway, it's a small point. The other one is that I think when you add up all of his tenure, there is a net loss. So there's no net profit over the entire period. Probably need to be a little bit fair with COVID that's in there. And like it or lump it, I don't like it at all. In fact, I really dislike it. But man, did he negotiate the sweetest of sweet deals from the government, not just in terms like the range of different benefits that he managed to, give a few Chairman Lounge access seats passes, and the money flows is all I'll say.
That's the wild thing, is we seem to, like, everyone is correctly outrageous that the Prime Minister's son got his own
Chairman's
separate
Lounge.
membership. Membership, which is like, you can't buy your way into this club, right? It's just
Secret
invitation
elite club.
only. So it's like, I would love it if it was standard for the sons to inherit their dad's membership status. Unfortunately, I can assure you that is not standard treatment.
Once the landed gentry come back, Claude, you'll
that'll teach my dad for telling me that I wasn't the son of a lord. Ha! No, the issue is that we seem to have just accepted that it's normal and okay for every single politician to get a Chairman's Lounge membership. They should all have to sit in the economy lounge with the plebs.
Yeah. No,
that would be democracy. Like, it's all absurd. Oh, this one membership to the son is obviously out of line, but why are we okay with them all having it? Like, they shouldn't get this special treatment from this carrier, and then collectively those politicians make the decision about whether that carrier faces competition. And it's all very well and good to criticize the government for, blocking competition for Qantas, and, the prior government for giving them, billions of dollars for free and not demanding an equity ownership like they did in New Zealand. But the issue here is both sides of government are doing things like this. The opposition is not standing up and saying, this is an outrage, we should be getting equity in Qantas.
No,
the opposition is not standing up and saying, this is an outrage. None of us should have the Chairman's Lounge membership. The problem is they're all in on it, and we shouldn't really accept that, should we? I think that I would have hoped that would be something that could unite most of us as Australians.
One other point I'll just make here on bringing it back to the stock market is I kind of saw some parallels between Alan Joyce and Jack Welch. So Jack Welch was the CEO of GE, ran it for many years, and was held up as a hero. Books like Good to Great was all about how amazing he was as a corporate leader. After he left, it all kind of fell apart because a lot of the things he'd done to kind of get earnings up each quarter undermined the long-term viability of the business. I mean, the most obvious one right now we're talking about is like the customer relationship damage, where Qantas has gone from this beloved carrier to being, universally hated, but also just all the other things behind it. So they've delayed heaps of capex. So they have not invested in their fleet, which makes everything look a bit nicer in cash flow for a while. They made a lot of cosmetic kind of accounting changes during the GFC where they, so that they don't need to report any depreciation and amortization, just took a big loss on it all at once. And so all that stuff now, you could be, I think it's reasonable to expect a lot of stuff to come out of the woodwork, so to speak, of these other short-term decisions, and then how that can kind of undermine profitability and growth for potentially a long time to come. So I think that'll be an interesting thing. How much were they sub-optimizing for?
I couldn't imagine wanting to own Qantas shares right now. It's like you'd bet anything that it's been optimized for the last results that we've just had in August, right? Like, you'd bet anything that that's the peak result for like 70 years or something.
That's such an excellent point, Matt. I just hear. That was so well said.
Let's move on to, thank you, Andrew. Let's move on to some, we actually just got a reader question. I should mention this one too. So I've cut off your name. Apologies when I've screenshotted this to myself. He says, hi gents, been enjoying the last 15 pods or so. A topic I imagine a few people would enjoy is a discussion of your tech stack. Is it just ASX.com, FactSet, CapIQ? Do any of the new players, for example, Ticker, support Aussie Micro? Thanks for any thoughts. What do you guys reckon?
I don't want to mention the one that I use because I'm not going to say something nice about it.
Okay, so just say you use like a gold-plated, like one of the top data providers.
Yeah, one of the top data providers. I do it because we need a data feed for Strawman, and it's just absolutely egregious rent-seeking talk about robber baron stuff and just
oh
like
man,
awful customer service, like just crap data. And I don't understand.
And if they cut us off, we'd be like being like, no.
I don't even, I mean, honestly, I feel as though it's like it's bits of data that from public markets. I find it so egregious. There's obviously a bit of work for collating sort of financial data and other kinds of things like that. I honestly don't know, in a world where you can have AI read text, where this isn't completely disrupted in the very near future. I just don't understand it. But anyway, my general point would be, I think data is massively overrated amongst private investors. I think if you've got the internet, you're good, man. You know what?
Especially in small.
ASX.com/announcements. Go there. Primary source material. You'll get a lot of really, really, really great stuff. And
I will say this. So I have used various data providers. There are a few big ones, Refinitiv, S&P, and there are other ones that sort of repackage, and Reuters is the other big one. And then there are all other data providers that you get basically are just repackaging that data somehow. And one of the reasons why you're seeing like all of these smaller, newer players more aimed at retail investors now is because over the last 10 years, those big data providers have loosened up on their policy on sharing it to other people. Now, I've worked with data providers, automated data providers in our previous role for a company that creates a lot of automated content. And I can tell you for sure that at a mass level, there's heaps of mistakes in data. So it wouldn't be something that I'd ever, I think looking at a data provider is great for getting a fast picture of something. And that can be useful if you have to go on, Ausbiz to talk about some, 10 stocks in an hour and you don't know all of them too well or whatever. But in terms of getting to know a company well enough to actually invest shares in it, a data provider has no role in that. Like it just, even though I've had access for 10 years to that, it has zero role in it. I just do not use it. It's just not, it doesn't add anything because I need to understand the devil in the detail. And that means reading the reports myself and taking out the numbers that I think are most important and distilling it. Then it's a lot of noise when you've got a screen full of numbers. And then the other thing is I find that what I do use them for is I look at estimates, and they're a blessing and a curse as well, because there's a company I've been prevaricating about recently, and it's a tough one because I think it's probably cheap enough anyway. But at the same time, I think the analyst estimates are too high, so I don't think it'll perform as well as analysts think. And I'm just thinking, well, does that mean even though I think it's a good enough price, it's silly to, it's not a good stock because it's just going to be disappointing the analysts in the short term and it's going to get downgrades and that kind of thing. So I'd say the big thing is data providers can be useful for finding out what other people think, but there are multiple sources of that, and you definitely don't need a big data provider that provides all the companies on everything in the world. If you're investing in ASX stocks, there's a number of different companies that you can get an idea of what the estimates are from, and I would say that's probably the main piece of the puzzle that would be at least useful in potentially understanding short-term movements. But the other factor is I wouldn't be using analyst estimates to actually invest anyway. So I don't think that is a ticket to outperformance anyway, but that can be a useful thing to understand, for example, why the stock went up or down at a certain time, which could calm your nerves, and therefore I see it having some utility.
Can I just add one very quick thing too? What you've got to be aware of in small cap, micro cap, nano cap land is the percentage of these analyst reports that are paid for. In other words, and it's always going to be positive, right?
And the other thing in baby investing, small in the baby giant continuum, part of what you're trying to play on here is the progress a company makes from when it has 0 analysts covering it to 1 to 2 to 3 to 4 to 8. In some ways, just the number of analysts covering the stock might be more meaningful than what they're actually saying.
Yeah, I think also there's been a change to analyst coverage over the last few decades. Analysts used to cover things to drive brokerage, so they'd put out try and do an idea and get people to trade the stock. And today in Australia, a lot of analyst coverage is primarily motivated by capital raisings and sell downs, because that's where brokers today make most of their money. They don't really make much money trading stocks anymore. Most brokers make their money from taking a much larger commission of a capital raise. And so that means when you see a new broker initiate coverage, my first thought is like, are they going to raise capital or is it going to be a sell down? Both of which aren't often ideal as an investor, right? Like you get diluted or there's a big kind of depression on the share price.
scumbags.
So I'd say,
God, I hate our industry so much.
It's just incentives, man. It's just incentives the way it goes. It's a flip side of free brokerage, I guess. But yeah,
I also think it's a snake pit.
It is a snake pit. Oh man, a very quick story. We'll talk about Dropsuite in a minute, but we spoke to Sharif recently, Strawman. He made the mention that because they're very well capitalized and profitable, and basically the brokers would ring up and said, "Oh, you should raise money, so you can get more institutional people onto the books." And this and he just said, bugger off. Which, I mean, my estimation of him just went up massively after saying that. But it shows you some of the pressure that these CEOs are on, and if you're not sort of a fay and across sort of a lot of the incentives that are here, and you're perhaps new to markets, and you just think, well, this is, I guess, how it's done, and they're plausible enough at a surface level glance as to, oh yeah, I guess that could be a good thing for the shareholders in the company. And it's just snake pit, as you say.
Yeah. So capital raises a broker can make whole percentage points. It could make in a small cap could make 5% potentially of the raise is like the fee that goes to the broker for organizing it. It'd be less for the bigger that you go, obviously, but you compare that to brokerage. It's just brokerage would be fractions of a percent kind of thing. So you make a lot more money from it.
And they're fair weather friends too, right? You get the discount. Oh, it's a discount to the VWAP or whatever. And they're gone as soon as they can get a little bit of a return on it. They're not long-term supportive patient capital.
That can happen. Yeah, that can happen for sure. The more desperate it is, the more likely they offer a big discount just to people who are going to flip it.
Just going to flip it. I'm going to flip
this impacts how companies run their business as well. I'll keep it anonymous so I can be really frank. But there's a company that, I've followed for a very long time that back in 2021, it really needed to start making the transition between just revenue growth to actual break even and profitability. And I remember talking to the CEO about it at one point. It would have been in 2021. And it was obvious these guys, their trajectories were not looking good. So I was sort of asking, when are you going to start getting this to break even? Why aren't you doing better cost control, essentially? And the answer was more or less the brokers that we've been talking to were just saying, look, just keep on growing that revenue, and we'll just raise you more and more cash. And as I liked this leader, so I was like, look, I'm going to let you in on something. The brokers do not have your best interest at heart. They are, and it was just amazing to me, someone that's way smarter than me has achieved way more in business and in life than I have, but they really genuinely didn't seem to understand this point, that the lines they were getting for brokers was because the brokers only cared about one thing, which was that they raised more capital. They didn't care if it happened at $1.50, $1.50. And they were a terrible person to listen to, because they would like you to ran your company into the ground and then have to raise capital. So, and the more the better. So, anyway, I sold out of the company at that point, and 2 years later, it's share price is no higher, and that's not really surprising. Just due to the fact that the strategy was so ill-informed. It was 2021. Things had never looked more toppy. Things was never pumping harder. And they were basically thinking that this capital raising environment would last forever. It wouldn't.
Matt and I were talking yesterday about another private company, and it hasn't gone well. And I think what your comment, Matt, was nature is healing, which I thought was spot on, because things are pretty wild there.
Yeah, things were very wild. And they're still a bit wild, to be honest, in that VC world. Just quickly on data. So I use CapIQ. I've used that for a very long time because I used it at Motley Fool as well. I find it quite useful for the raw data. So the actual stuff you'd find on a financial statement, like income, whatever, the balance sheet, etc. I find the calculated fields are probably where I normally see errors. So if you're going to ask it to give you free cash flow, it does a lot of that stuff. And also gross profit isn't something a company reports. I actually really like it for the pure
I'll give
data.
a big up to Matt here. He understands the raw data, and we're talking about raw data that you can get through an SQL based database as well as through the web portal here. But Matt, you would be the top 10 or 5 people that I know that actually understands all the quirks and risks of their data.
Thanks, man. But yeah, that's how I use it. I use it into a spreadsheet and do stuff with raw data. I would say though, Ticker uses the same data and is a fraction of the cost. And so, I'd agree with all the advice or thoughts that Andrew and Claude had around data, because I'd say for individual investors, you can get almost everything you need with a Ticker subscription, which is pretty cheap, or Koifin or some of these other ones. I think they even have free products as well. And just doing the legwork yourself. I would say so I run a fund as well. There's a lot of other alternative data products that, hedge funds, etc. use. And I think that those can be useful, but they're very expensive. I've been quoted $100,000 for some stuff, for access to alternative data. And so what some of the stuff funds will use for, like, in the US, I think it's more of an issue, but you can see like credit card spending, anonymized credit card data for like 10 million, 20 million people. And so, people can kind of see, like, you could track basically, are people spending more at McDonald's in the last 3 months than they did a year ago, for instance. You can track all sorts of crazy stuff. And it is very impressive. I would say it's just, I guess it would be overkill for most people. I think there are some interesting alternative data you can get. And I guess I would say often you can get a lot of it. You can get kind of 90% of the way there for free still, just by kind of hustling and looking at free alternative sources of data. But yeah, there is some potential for edge. I know that a lot of these hedge funds people spend millions of dollars on alternative data, satellites, everything. I think the other thing about it, though, is it only gives you really an informational edge. And informational edges are probably one of the smallest or hardest to maintain, because if you kind of think through informational, analytical, behavioral, or technical, some people kind of say time horizon as well. The informational one is like everyone else can get that data as well. And if the person's selling it to you, they're selling it to everyone. So yeah, I guess coming back like full circle, you get 90% of the way there with stuff that you can get publicly available. And then you actually add a lot more value doing your own legwork or finding other little free alternative data sources. I love finding those, and they're free as well, but also, they're not being marketed to everyone else. Like it's not.
I think in small caps, sometimes the informational edge that can be super valuable is literally just picking up the phone, pretending you're a customer, picking up the phone, talking to a competitor, picking up the phone, talking to a genuine customer. Like that, you can get genuine informational edge like that, and that can be good. I'm not saying you should. It's just one factor in many, but I wouldn't sweat it on data providers if you're doing small caps in the ASX, put it that way.
Yeah. And on that point, I agree with all of that, gents. And I think another point I would make is that, data is all backward looking, right? By definition, this is what sort of happened. I think particularly when you're dealing with early stage companies, it's just less and less helpful. I've found that over the years, I've just erred more and more and more to the qualitative as opposed to the quantitative side of things. I mean, the numbers are important. They'll tell you a story and you need to see that story sort of playing out. But I think just having a clear understanding of the business model, of the mindset of the leadership team, and just by following some of the interviews that they've done or some of the comments that have been made or things like that just don't fit into a spreadsheet, but are just vitally important, I think is something that, particularly for, as I say, for early stage companies, I think that's something to focus on.
But in terms of the full tech stack, which was the question, right? I don't know if you guys are different now, but I use Excel, I use Google Docs. Some people send me stuff in Word. It's like slightly annoys me, but I accept it. Yeah, that. And then what else do you guys use to like note taking? Is there anything else in the tech stack that you guys have that's useful there you want to chuck in?
Google Docs, Google Sheets.
Yeah,
it's all pretty basic free stuff.
Basic stuff.
Strawman.com.
Yeah.
Yeah. No, so like I also see Strawman.com as like a research data source. Like it's great to know what other investors have put their mind to it.
Send you a six-pack of beer afterwards. Thanks.
It's like a non-insane version of Hot Copper.
I'll take it.
Where the other question, I guess, when tech stack it alludes to brokers, I don't really have anything to say about that because I use what I use because that is what I opened when I was like 19 years old. So I don't think I'm a good example to anybody. Do you guys want to chuck in anything there?
I mean, I use Iris. I don't think I'd say you're missing out on anything by not having it, though. It's got some technical stuff that are useful for what I do, but other than that, no, I don't think so. I think the standard stuff that you get with like a Combank thing is.
We have nothing to add. You guys can figure out which one suits your needs, basically.
I by the way, I think I'd be worried investing in Iris. Has actually had a pretty awful. They used to be such a great company. Like they had all the things going. So many nice. Speaking of,
it's a fallen giant.
I really well. It had
it's an
any
aging
kind of metric
giant
that you want to point to, which is you could do a real case study on this. And I think that
But he had a good life, Andrew. That's the point.
Same with Bloom. I mean, one day we should do a case study on Bloomberg. Like, wow, what an incredible business. But again, I don't see how that edge is going to be maintained. But anyway, We're running out of time and there's other companies to talk about.
Small caps. Welcome to the people who've just skipped the first half an hour of chat. Here's the bit you've been waiting for.
All right, should we start with step one?
Yes, yeah, sure.
Oh, so step one is online underwear. So it's an online seller of men's underwear briefs. What would you call them? Boxer briefs. And kind of had like a very iconic style, made of bamboo, supposed to stop chafing, but launched I guess, shortly before the pandemic, right? But kind of took off during that time. And yeah, just did good online marketing, I guess would be, it had got up to like very success.
Good IPO marketing also.
Good IPO marketing. Success out of nowhere. IPO'd right at the top of that interest in, e-commerce, and has fallen significantly in share price since then, but has since had potentially a bit of a bounce. So interested your thoughts on the latest results, Claude. I know you wrote it up on arichlife.com as well.
Yeah, that's right. So I wrote out a flash article on this one just because the results, in my opinion, were a short-term buy opportunity. I don't own shares. I'm not saying you should buy shares. Definitely not a recommendation. This was at a lower price as well, by the way. But it caught my eye because it's just a turnaround story. We have a situation where there is a genuine business there. They do, I would say, probably not that cost competitive underpants in terms of you'll end up paying 25, 30, something like that per pair of underpants. Mm-hmm. Whereas obviously if you were actually trying to just buy low cost underpants, you could get a lot cheaper than that.
How much do you spend per underpant, Andrew?
I'm in that stage of life where my wife does all of that kind of shopping. So she reaches a point where she goes, "Oh my god, they are threadbare. They're fine.
Off. Yeah.
They're fine. Another year out of these."
Yeah. So I guess was a little bit like that. However, Step One has revolutionized me into doing my own underwear shopping, because I first bought it just to test it out. I was super skeptical. I was like, "This is basically just an outrageous pump. They can't be that good." And like, sure enough, they weren't that good. And I was like, meh, these seems pretty overpriced underpants. They're just one of the competitors in a crowded field, nothing special. Then the weird thing that happened is suddenly over the course of the next 2 years, all of my underpants gradually became Step One underpants. Because it started with like, you don't really realize straight away that it becomes like the favorite one, but you kind of do know on an instinctual level, whichever your most comfortable underpants are. And so, I guess telltale moment was when I'm like pulling on my favorite, like colorful Step Ones for my wedding. And I'm like, these, maybe I should buy more of these. And it's starting to get those like associations for me. Like, okay. So it's actually taken over my underpants drawer. Wow.
So this is multiple orders, right, Claude? You've been ordering many times.
Yeah, over a couple of years. Okay. A couple of years. Like even begrudgingly at first, because I was like, stupid overpriced IPO ripping people off,
What do you think about this, Andrew? You've got a bit of a smile there. What are your thoughts on this?
I'm just scrolling through the Prezzo and no, I think. I tell you why I was smiling.
Don't scroll through the Prezzo. Scroll through my article, mate.
Why were you smiling?
It tells you everything you need to know.
So I think I mentioned this to you the other day as well, Matt. There was I saw for some reason some clip of a Shark Tank episode.
Oh, yeah.
And this dude had invented these underpants that had like a little slot for the Franken beans, basically. It was the craziest idea in the world. Anyway, they said, "Well, what do you want for it?" And he was like, 500,000 for 5%. Like, what? They're like, "Do you have a patent on this?" No. And then one of the sharks said, "I'll give you 500,000 for 15% or something." And no deal. I'm not giving my business idea away. Like, what? Anyway, the world is mad, and that's why I was smiling.
All right, there you go.
Anyway, so let me tell you the financials though.
But maybe it was a $10 million idea. Yeah. I don't know.
Yeah.
Right.
So the problem with these guys until the most recent half is they were keeping all their profits in underpants. No cash, just underpants. And obviously that's not like, I don't accept.
How much of your profits are now stored in underpants?
Well, I never bought the shares, but anyway, so what happened is actually the second half did show slightly lower inventory. They did show a much better cash flow. Ergo, they can now pay a dividend. They've issued a 5-cent dividend. At the time this came out, it was a 47-cent share price. So you can see why, like, the chaos monkey in me was like, buy. But the catch is, of course, that dividend probably isn't sustainable. In terms of it's not really supported by sustainable free cash flow. I reckon the dividend's probably got to come down. On top of that, they're talking about they've got some bits of stock that they might need to write off, but or that there's an issue with there's like the dregs they can't move, and then they don't want to like have it on the website with only like extra small and extra large available or whatever. So they don't always nail it in terms of that. And also they've in order to become profitable and get free cash flow, they have taken their foot off the accelerator of growth, and as a result, their revenue's gone down as well. So it might be on a PE of 11 or whatever, but it it's not growing under the current settings, and it's
and revenue is down like 10% or something. I think you said in your article.
Yeah, it's hard to predict what the returns for Google inventory are for selling advertising for underpants. Well, you can be certain that it's not always going to be favorable though, because it's a competitive field, as I said. As a result, the arbitrage of competition is always trying to take that margin away from you. Like, this is not a business that should be like a 15%. It's not a software business. Like, it's probably going to have some real slim margin, which they can probably gradually widen the more people like me start to get attached to the brand. And I think they are doing that. I think that's why it's interesting. But having said that, the interest in the stock presently is just turn around from the absolute bottom. It's gone from 30 cents ish to 60 something cents now. So I'd say it's like largely played out. I'm not sort of trying to say it's some great stock idea. I don't see it becoming a giant, put it that way, but nonetheless, interesting set of results.
How much did it get up to? It was up over $3.
$3.
Yeah, $3.
$3. Yeah.
Yeah. I mean, I think it's an interesting one, Claude. I mean, it did take over it became a brand that you chose to after first trying it out,
So that's how it could get a margin, right? If there are enough people like me who are like, oh, that's probably, every 6 months now I buy another pack of 4 or 5 or whatever, however many it is.
Jesus, 4 or 5.
If there are enough people like...
Someone's rolling,
well, that's
man.
The thing is,
are you putting on a fresh pair every day? What the hell?
About $30 a pop.
It's increasing it has definitely increased my like underwear spend over the course of time. Yeah. Like, it must have at least doubled it.
Yeah.
And do you know what it gets you in? Well, it depends on the people. I'm sure there are lots of people that just want black or grey underpants or whatever, but I'm, as you guys would know, like a sucker for the colourful designs. And
you want a dolphin on there or something?
Yeah, like, oh, there's a new design of underpants that like nobody except one person sees.
Maybe that's the secret. I mean, it could be the secret. Maybe they need to lean into that a bit more, because there's also that Happy Socks is like super colourful business socks that like took off as a brand.
Yeah, but I feel like using me as an example of a standard retailer is always how you
It'd be like the Homer Simpson car, when Homer designs a car for his brother.
The Homer.
Yeah. No, very good, Claude. I think that's a good overview. I think you nailed it. It's a transition point, right? Is this going to become a brand that's defensible, or is it a melting ice cube in terms of revenue, where it's like it had this good run and now all the competition's emerging? If you look on Amazon, there's a lot that look very similar to them at much cheaper prices, because the core idea isn't that big. But if you become a brand, you can keep charging $30. It's actually pretty interesting. So yeah, a good one.
And just a good reminder too of just the power. I'm usually really cynical when it comes to marketing. Marketing is it's the old joke of like half your marketing.
You're usually just really cynical.
I'm just cynical about most things.
No,
I mean, just and no offense to, as I said, people in glass houses, right? But I mean, gosh, some marketing people come up with some crap, and you know that half of your marketing budget is wasted. You just don't know which half. But when you get it right, it makes it rain. You've taken a commodity product here. I'm going blank, but there's actually a number of good examples, which essentially just commodity products, completely undifferentiated.
I mean, there's toasters that are $400. Like, you can get a $400 toaster, and I'm sure they do pretty well.
And it's just incredible. Like, you have to take your hat off to that, because it's sort of, you get that part right, it can carry you a super long way.
Yeah, just quickly, I think it's a bias that a lot of like quote unquote value investors have, where they're like, oh, this is all, immoral, like immoral to like use marketing, right? And it kind of misses that we're humans, not robots. All right, should we do Dropsuite next? What was the latest on that?
Oh, I so want to touch that, but I'm not going to.
That's enough. We're going to have to start.
If you're a short seller, you'd be very worried, and you'd be covering your position, I'm sure is what you meant.
I just said if I was a short seller. Didn't say anything else.
Andrew, were you looking at Dropsuite? Did you want to cover that one? Or?
Yeah, we came and spoke to us again recently, almost a year ago to the day. And so Dropsuite, as many of our listeners probably know, they do backup for enterprise. It's something crazy where like 80% of enterprise customers don't back up their SaaS applications. So everything from sort of like email to Xero and QuickBooks and all kinds of things. And it's very important I think the tailwind here is that cybersecurity is becoming an increasing issue. And the idea being is that even the T's and C's of like the Microsoft suite will say, we recommend that you go with a third-party provider. So they do that. And they've actually, again, picture's worth 1,000 words. I'd encourage people to go look at their decks. They have built this platform from the ground up. They have been winning a lot of work. They are firmly profitable and continuing to invest. They've got their balance sheet is in rude good health. There is strong tailwinds there. The CEO is a really nice origin story here. He's like, actually, I think he led Google Singapore or Southeast Asia for a while, was a massive investor in Dropsuite, was a private business, and then took over it. And I think he's the third or top 3 largest individual shareholder and has been there driving the business for a long time. And I very much get the sense he's a long-term thinker and a long-term making very sensible capital allocation decisions. I've got a small holding, I should disclose, not as much as I would like to have.
A small real life holding or a straw man holding?
Yeah, both.
Hey,
yeah, it's a
welcome aboard.
Yeah, I mean, there's so the thing that a lot of people will be aware of is that Microsoft came out with its own sort of competing product. Well, actually, there's 2 parts of the story. The first part of the story was the AFR wrote, I shouldn't say puff piece, but a very favorable piece on it, and shares just went whoosh. They jumped up 30% or something, and then it was revealed at a conference that, well, actually it was revealed much before that, but it just sort of got noticed at a conference that Microsoft's Syntex platform is offering similar kind of stuff. And so I was like, it kind of makes their offering null and void, to which Sharif sort of said, actually, this has been coming down the pipe for ages. It really doesn't change a lot of it. No CIO is really going to want everything held on the same kind of server infrastructure and the rest of it. The product, the market is significant and large enough that we feel as though we're just fine. So obviously he's going to be telling the good story there. But I feel as though, so the other thing that's really important to note with Dropsuite is that they operate, their customers are essentially MSPs, managed service providers, small IT providers that sell to customers. So and this was a very deliberate strategy. It helps them scale a lot faster, and the rest of it, they don't have teams of IT professionals running around installing and managing all this stuff. It just gets sold to these other small businesses essentially that then go on and do that. And so what's my point? My point is, I think that the threat is overblown. Shares are not necessarily dirt cheap by any traditional measure, but I think that this is a very interesting company. I don't know. What would you say? You were in the meeting, Claude. What did you pick up?
Yeah, so I own shares as well. I think one interesting thing from the meeting was that Sharif mentioned that it was a lot of retail shareholders churning after this Microsoft news. That would suit what I would think as well. I saw like a large amount of panic from retail shareholders. I had quite a few conversations with smart retail investors on that day who seemed to me to be very worried about something that I thought was a negative. I don't know. We had a good chat about it as well, Matt. We're like, I don't think it's great that, Microsoft might be having a competing product, but I think that there are other weaknesses in the Dropsuite's business model that I'm much more concerned about than a more expensive product from Microsoft, which is they're often backing up Microsoft. So there's basically the selling point like, hey, do you want to be the guy that made the decision to have your backup with Microsoft of Microsoft? And then what gets compromised is your Microsoft admin credentials and you lose it all. And then you've run up to the CEO. It's like, have you got our backup? Oh, sorry, boss. The backup's with Microsoft as well. Like it's, that's not going to be a good career move. So I'm not so worried about that. The thing that does concern me about, and I own shares, and I think this is a very interesting long-term growth, profitable, organic growth, small cap, so I don't want to sound like I'm down on it. They don't give very good visibility into their customer concentration. They just say like the top 10 is 65%. Well, if the top 1 is, 45% and then it's small after that, that would be a great concern. If the top 1's 15% and it's sort of, there are a few that are like 15%, then that's not so bad. The fact that they don't give granularity within that top 10 and, it suggests that the actual answer is not great. So that's the number one risk I worried about with Dropsuite.
Yeah, nice. Yeah, I've mentioned it before that I think another potential negative is that it's selling something that isn't really needed most of the time. I kind of called it volcano insurance, like going door to door selling volcano insurance. And they're like, we don't have volcanoes. Like, don't you think we're overdue? And I just kind of want to for the cloud backups, I just kind of think, how big of a disaster would it be for Microsoft to lose all the data that they're holding for someone? Like they probably do a lot of work to back it up. But I think that you made a good point of admin credentials. There's probably some cases where it's enough there to at least spook the people to take that extra thing. And so it doesn't even matter, frankly, if it is volcano.
Well, if you're buying volcano insurance, Matt, you want to make sure it's good volcano insurance.
I think it's also like the extended warranty. Maybe that's another way of framing it. Like the extended warranty, that you sell, and that's just a huge profit margin thing for JB Hi-Fi or whatever to get in that extended thing.
So if it's prone to getting disrupted, and that's the risk, right? If it's an extended warranty, if it's not something that's an absolute fulfilled need, it's prone to getting displaced itself. But at the same time, as you said, extended warranty is a profit center, right?
Yeah.
Like while it works, it can work quite well, and that's what I believe we're seeing. And the guy, the CEO, I do think he comes across as he's a long-term guy. He's been there. He's stewarded this for 10 years, right? And what he's stewarded it to, despite ups and downs, despite losing a big customer at one point, despite, I think, when they first launched, when they first came to the share market, they seemed to be associated with people that didn't give me a lot of confidence. But since then, the actual business development itself has given me more confidence. If you just look at essentially the results, like this is a good, strong organic grower at the top line, and it is profitable at the bottom line, whilst profit is not its current focus. So this can be a good setup, because if you can just hold that position where you're reinvesting everything and you're getting strong revenue growth, then 1 year in a few years' time, you'd hope they'll be like, all right, this year it's about the profit, and then suddenly they can start getting much bigger margins, and then you have to ask, what is a feasible margin for this kind of business? And this wouldn't be a high margin software business, so I wouldn't be modeling 15% profit margins, though that might be possible at its peak. But it's growing fast enough that it doesn't have to be a super high margin business in the end to still do quite well.
Yep, nice. All right, let's move on. Quick one, run through LaserBond. Pew pew. What was the latest? Thoughts on the latest results, Claude?
You go for it, Claude.
Well, okay. Essentially, the top line news for LaserBond is that it has three divisions. It has the services division, it has the product division, and it has the technology division. And the company had previously said basically that they're expecting some pretty significant revenue from the technology division. The technology division is simply licensing their technologies under a variety of different models, some of which are probably more profitable than others. But whatever it is, it's high margin revenue because they don't really have to produce much. And so that just falls down to the profit line. And once again, unfortunately, they've disappointed on that, and they have not been able to deliver their products, because I guess there's changes, or they've had a lot of supply issues with the different parts. So, again, it's all about they're saying, it's now expected to recognize revenue in FY 2024 once the issues are resolved and the customers take control of themselves. And then they're also saying they've made an additional sale to Swinburne University, and it's expected to be commissioned late in the first half of FY 2024. So if these actually come through, we might be seeing some profit from the technology division, and we could be seeing some great results in FY 2024 because of that. But unfortunately, their prognostics have not been accurate on this at all, so it wasn't that good. So I wouldn't rely on that. And then on top of that, the product division also down slightly. So not really a fantastic result there. That's using their technology to make products that they then sell for a profit. So not totally ideal. Their revenue was up, but their EBITDA was down there. So I guess you'd call it a mixed bag. But the star of the show was the services division, which continued to, it had good revenue growth. It had good profit growth. That's going well. That's driven a strong result, which has supported the share price up. Another one I own shares in. Good to see that core business going well. I guess, Andrew, I think you own it as well. So I'm keen to hear what you think. But, the general idea would be that through using their technology and allowing mining companies to repair and extend their own equipment that has wear and tear, you can get a solid profit from that because you're saving money for the customer. And so, and they, have a bit of a distribution network, and you have to be close enough to the customer. And then they have a bit of a technology mode as well. So you could totally see why these guys could make a sustainable, decent profit margin. And when we're seeing them making a profit after income tax of 4.8 million on revenue of 12%. Under 40 million. Yeah. So I think that is pretty decent. And so, yeah, it's not your best business in the world, but 12% net profit margins, a growth. And also, I think we've discussed before, we're quite partial towards the honesty and competence of of management. You have a sort of founding family that's in control. So yeah, a lot of little boxes to tick there, which is why I own shares.
I'll keep it brief. I echo all of that. It's a family-run business. They're very long-term thinkers. They've made a lot of sensible investments that just take time to bear fruit, and I think it's starting to bear fruit. It's never going to be a straight line. They did reiterate their FY25 target of 60 million in revenue, so compared to 38 million at the moment.
Though I would add they've missed their prior targets as well. So yeah.
I mean, I think it's more of if they're directionally correct, I put stock in there. Let's say it comes in at 50 million. And the other thing that I remember when we spoke to them, gosh, must have been about 9 months ago or so now, they were saying that they felt net margins could potentially get as high as 20%. Not a forecast, not a promise, but just the scale potential within the business was there. So I think you've got a situation where you've got long-term thinkers, strong growth at the top line, expanding margins. Yeah, I like it.
And a PE ratio of 20 as well, right? So a little bit of debt on the balance sheet, but a PE ratio of 20. So yeah, I mean, at 10, you'd say it's darn cheap. And at 30, you'd probably say it's super expensive. So it's probably somewhere in the realms of realisticness.
Yeah. Very nice. All right, let's wrap it there, gents. If anyone has any questions for us, hit us up on Twitter at BabyGiantsPod. And until next time, thanks for listening.
Cheers.
See you, everyone.